The COVID pandemic was a defining disruption for the hotel industry, and its aftermath has brought about lasting changes in the hotel business practices. Even with COVID denting results, the hotel sector still outpaced the broader market, such as Indian Hotels Company that notched a remarkable 56% CAGR. The industry has largely recovered to pre-pandemic performance levels and exceeded them on several metrics, such as occupancy levels, which dipped to a low in FY25 at 34.5% and is now back at 67.5% in FY24. Moreover, the industry sentiment is back from COVID lows, with sectoral valuations higher than ever before. The average daily rate for rooms across Indian hotels has also surged from an FY21 low of 4,630 rupees to a new peak of 8,055 rupees per room. Although COVID did more than just dent numbers, it rewired the hotel operations and transformed how guests interact with them. One major shift post-COVID is the greater reliance on domestic demand. Before 2020, foreign tourists drove luxury hotel occupancy in places like Goa and Udaipur. When borders shut, hotels shifted focus to domestic luxury travelers, Indian families replacing their usual foreign trips. By 2022, domestic guests accounted for nearly all leisure demand, and though international arrivals have resumed, hotels now depend less on them. Another shift has been the sprint to digital. Before 2020, digital check-ins and mobile keys were trickling out. Then, COVID demanded contactless everything: QR code menus, app-based services, requests, virtual tours, all rolled out in weeks, leapfrogging years of tech. Now guests expect it. For example, IHCL's move to Tata New digital platform saw direct digital bookings surge 43% in FY25. Even meetings went hybrid. Hotels upgraded setups for smaller blended events that were once niche. Clearly, the Indian hotel industry is poised for robust growth in FY26, building on a strong post-pandemic recovery. So let's dive deep into the hotel industry. Welcome to Bottom Line by Grow. In today's episode, we dive into the sectoral outlook of the Indian hotel industry, unpacking its recent shifts, key challenges, what the future holds, and how leading companies are performing in this market. India's hospitality market is dominated by the unorganized segment, with independent, unbranded hotels comprising over 2/3 of total lodging supply. As of 2024, India had 2.48 million lodging rooms across all categories. Over 67% of these are small unbranded hotels, guest houses, or homestays, whereas branded hotels account for only 12.8%. The remainder includes emerging segments like alternate accommodations like homestays, 11.4%, and aggregator-backed budget hotels, 8.2%, like OYO. However, this imbalance of roughly 90% unorganized versus 10% organized by rooms is stark even by emerging market standards. For instance, only 1.5 lakh rooms in India are in the classified branded category versus an estimated 29 lakh in unbranded independent hotels. In other words, branded hotel rooms form barely 5 to 7% of total lodging supply, underscoring how underpenetrated the formal hotel sector is relative to demand. In comparison to global peers, despite having roughly 4 times the US population, India offers just 0.1 branded hotel rooms per 1,000 people compared to 16.3 in the US and even China's 3.2% per 1,000. China has been bulk building branded supply in its smaller cities, and India is only now catching up. Now the upside? This low base means huge opportunity as income rise and travelers demand quality. Branded hotels can grab a bigger slice of the market. Although several forces are now driving a gradual shift towards the branded segment, consumer preferences for quality, safety, and consistency have strengthened post-pandemic, favoring established brands. Hotel chains offer distribution advantages and loyalty programs that independent hotels cannot match. The economics of loyalty are compelling. For example, IHCL with its Taj hotels reports over 40% of its revenue from loyalty program members. Nonetheless, the transition is gradual. Moving on, to better understand the landscape, let's dive deeper into how India's hotels are sliced up. At its core, the market falls into three pricing tiers. Here's the breakdown. First, the luxury tier. Think of palaces and five-star icons like Taj Mumbai, where space, service, and spectacular views rule. This segment commands 34% of room supply, yet it captures 37% of demand. The pipeline share is matching that at 34%, so builders are betting big on more of these properties. No wonder they rake in 56% of all room revenues. Even in a country of bargain hunters, this top rung still fills 69% on an average night at an average daily rate of 12,377 rupees. Second is upscale. This is the business-friendly comfort meets style arena. Plenty of branded chains, solid meeting rooms, and decent spas. Here you'll find 38% of India's rooms, and it draws 41% of total stays, making it the busiest of the three. Developers are adding 40% of the upcoming pipeline here. Smart move, since it already contributes 34% of room revenues. Occupancy is right behind the top tier at 68%, and you'll pay about 6,550 rupees for a night's stay. Lastly, we have the mid-scale. Budget doesn't have to mean bare bones. You'll find efficient, clean rooms here. Think dependable chains or well-run independents. This room covers 27% of rooms, but only 23% of demand today. However, it's catching up, with 26% of the pipeline earmarked for future growth. It accounts for 10% of room revenues and fills 54% of its rooms on average, so there is some headroom. The price here sits around 3,712 rupees a night. Apart from the pricing tiers, another key change that can be seen over the past 3 years is that Indian hoteliers have gone all in on asset-light models via leasing. In the lease model, the hotel owner or lessor has no operational responsibilities, while the hotel brand or lessee is in charge of the day-to-day operations along with the majority of the financial responsibility. This model is attractive as it provides high return fee income with minimal capital employed. It also contributed to margin expansion. Larger chains are seeing improved ROCE because they earn fees from an expanding base of managed hotels without significant balance sheet burden. Another change is in the revenue breakup across the industry, as Indian hotels have evolved into multi-revenue businesses. Hotels generate income from multiple streams, chiefly room rentals, food and beverage outlets, and other ancillary services like banquets and spas. However, the revenue mix in India's hotel industry is notably different from many Western markets. Food and beverage events contribute an unusually high share of total revenue in Indian hotels. Over the past decade, F&B's share in hotel revenues in India has risen from approximately 37% to about 43%, approaching parity with room revenue. This trend is partly cultural and partly strategic. Culturally, Indian social life often revolves around more food and celebrations, and strategically, hotels have increasingly focused on F&B to diversify income as room rates face pressure in slower years. Amidst all these changes, it's clear that the Indian hotel industry has entered a favorable phase of high demand and increasing pricing power. This rebound is attributed to four main forces behind the hotel industry's swift post-COVID rebound. First, domestic leisure travel has been the standout driver since the pandemic. With international travel restricted in 2020 and 21, Indians turned to exploring domestically. A trend persisted. Another key driver was religious tourism. The demand exceeds supply situation was also pronounced in religious tourism circuits, where pilgrim arrivals run into millions, but quality hotel rooms were limited, leading to higher occupancy rates. Moreover, 5 years since COVID hit, revenue from key religious tourism spots surged. In fact, just by 2022, it had doubled, climbing to roughly 1.35 lakh crore rupees. Secondly, business travel has made a strong comeback in 2023-24 after a lull. By mid-2022 itself, roadshows and client visits resumed, and by 2023, most companies had employees traveling like pre-COVID. Third, MICE, or meetings, incentives, conferences, exhibitions, and weddings went from zero in 2020 to blockbuster business today. In fact, ICRA specifically highlighted weddings and MICE as key drivers for FY25 demand. Big fat Indian weddings have also become more lavish and often at destination resorts, translating into very high revenue per room. Lastly, beneath the cyclical boom, long-term drivers kicked in. Swelling middle class with rising disposable incomes, new regional airports and highways under UDAN, plus the government's push for e-visas and tourism development. Now let's zero in on how some of these companies rode the wave of the industry boom. Most hotel companies saw double-digit revenue growth in FY25 on top of the strong recovery in FY24 led by IHCL, which achieved a 23% YOY increase in consolidated revenues to 8,565 crores, crossing the pre-pandemic levels by a wide margin. This isn't just a one-off surge. Over the past 3 years, these companies have consistently delivered high double-digit growth. These figures underscore that FY25 was a year of expansion beyond just recovery. Many companies didn't just recover to 2019 levels, they surpassed them. But what are the underlying metrics supporting this growth? The first metric is occupancy rate, which is the share of rooms filled versus those available. Is a simple gauge of demand. In FY25, Indian Hotels Company sits atop the four at 78% occupancy. Lemon Tree, which peaked at 79% in FY19, has bounced back to 72%, still below its pre-COVID best. Chalet and EIH clock in at 73% and 76% respectively, signaling solid, steady recoveries. In short, IHCL's lead shows that it's captured the strongest post-pandemic rebound, while the others have stabilized and are closing the gap, but haven't quite returned to their glory days. Second, average room rate or ARR measures how much a room makes on each occupied room, basically total room revenue divided by occupied rooms. Since FY19, every segment from economy to luxury has hiked their rates sharply. IHCL in the luxury segment saw its average room rate surge 56%, and even Lemon Tree in the mid-scale hotels saw ARR climb 53%. This surge shows pricing power has fully returned to the hotel industry. Third is revenue per available room, which is total room revenue divided by available rooms. This is the purest gauge of how well a hotel monetizes its inventory. Since FY19, every top chain has lifted RevPAR. IHCL topped the list with 10.3% CAGR, EIH followed at 8.9%, while Chalet and Lemon Tree trailed at 5.7% and 5.6% respectively. Crucially, all hotels have now surpassed their pre-pandemic levels. It's not just about filling beds anymore. Hotels are extracting more revenue from each room, proving real pricing power and operational efficiency. Bottom line, the surge in occupancy, room rates, and revenue per available room has driven operating profit margins to record highs well beyond their pre-COVID peaks. Moreover, despite a COVID-driven downturn, these stocks have generated staggering returns over the past 5 years. With this growth, how do valuations look? While these chains have delivered stellar growth, yet their current EV to EBITDA multiples sit comfortably in line with or below their 5-year medians. Most are trading at modest discounts to history, and even ITC Hotels, despite its newer listing, occupies a perfectly normal valuation range. While the outlook is bright, the Indian hotel industry faces a number of challenges and risks that could impede growth or erode profitability if not managed properly. Firstly is the lagging supply growth. After a period of stagnation, hotel supply in India is once again on an upswing, though growth remains moderate relative to demand. However, relative to the booming demand, supply growth is still lagging. According to experts, new supply is likely to increase at only 4.5 to 5% CAGR in the medium term, which would lag demand and thus support the ongoing upcycle. Moreover, this supply-demand imbalance actually underpins the high occupancies and rising rates currently seen. Several structural hurdles contribute to this measured supply growth. primarily is the high capital costs and land acquisition channels. Building hotels in India is expensive. Land in metros is costly, and suitable plots are hard to come by. A luxury hotel can have a land and construction cost exceeding 2 crore rupees per room in prime areas. Even mid-scale projects cost 50 to 80 lakh rupees per key in many cities. Then there are the lengthy approval and licensing processes. Building and opening a hotel in India requires navigating a labyrinth of approvals, from environmental clearances to police licenses, health department NOCs, fire safety, tourism, department classification, etc. The process can take 2 to 4 years or more just in paperwork and dealing projects, adding costs. There's even scarcity of institutional capital for hospitality. Unlike other sectors, hotels in India have not attracted large institutional investments historically. Cumulative FDI into Indian hotels to tourism since 2000 is 1.14 lakh crores, which is only 2.56% of total FDI inflows, indicating relatively lower foreign investment in this sector. Moving on to the second risk. This is intensifying competition landscape and consolidation. With high demand and more players eyeing India, with international brands such as Accor and Radisson increasing competitive intensity. Even at mid and budget end, domestic chains are proliferating. While demand likely can absorb new entrants, individual properties might feel the heat if a stronger brand opens next door. The industry might see rapid consolidation, especially across smaller chains like the recent merger of Larissa Hotels with AM Hotel. Consolidation can be positive as bigger platforms could lead to better efficiency, but also means stiffer competition for independents. Lastly, macroeconomic and external headwinds remain as hotels by nature are highly sensitive to economic cycles. Global economic slowdown or recession can quickly translate to rest travel. Given the interconnected world, India is not immune if the US or EU economy slumps in FY26. It could dent India's IT business travel and high-end leisure inbound, for example. So that's our deep dive into the Indian hotel sector. Unprecedented growth, new markets opening up, and a playbook that's been rewritten post-COVID. On one hand, we've never seen demand this strong, poised to get even stronger, powered by rising disposable incomes and double-digit growth in foreign tourist arrival. On the other, we know the unexpected can always strike. Rising interest rates, geopolitical shifts, or even the next pandemic. So what do you think? Are we looking at another golden decade of boom? Or is a plateau around the corner? Do drop your comments and thoughts below in the comments section.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.